What if I told you that accountants are actually time travelers? No, really. They can take money that's already been spent and push it into the future. Or they can pull a cost from the future right back into the present. It sounds a little like science fiction, doesn't it? But it's the absolute key to understanding if a business is truly doing well. Okay, let's get into it.
So let's start with a puzzle. A company's got a nice round $100,000 cash sitting right there in its bank account. Does that mean it made $100,000 in profit? I mean, it seems like it should, right? But the answer, maybe surprisingly, is not necessarily. And the huge difference between that cash and the actual profit a company makes, it all comes down to one thing: timing.
So here's how we're going to crack this puzzle. First, we'll dig into that whole cash versus profit thing. Then, we'll look at the guiding principle accountants live by. We'll explore what happens when you pay early but use something later, and the flip side, using something now and paying for it later. We'll even face the tough reality of unpaid bills. And finally, we'll see how it all comes together to create the true picture.
So really, why isn't cash the same as profit? Well, imagine trying to figure out how much water is flowing in a river by just scooping up one single bucket one time a year. That bucket tells you what's there in that one specific moment, but it tells you nothing about the river's real journey. Business is just like that river. It's a constant flow. But we try to measure it in these neat, tidy little boxes, like a month or a year. A financial year is really just that, an artificial box we draw around a period of time. But business is messy. It spills over the edges. For instance, a company could make a massive sale on the very last day of the year, say December 31st. The deal is done, the product is delivered, but the cash doesn't actually show up in their bank account until January. So if we only look at the cash in that first year's box, it looks like that huge sale never even happened. It tells a totally misleading story.
To fix this exact problem, accountants follow one incredibly powerful rule. This is the guiding principle. It's the rule book that lets them accurately sort all those messy, spilling over transactions into the right boxes. And that rule is called the matching principle. And honestly, it's just a brilliant common sense idea. It just says that any costs you have, any expenses, should be recorded in the exact same time period as the income they helped you generate. So if you sell something in December, the cost of making that thing has to be recorded in December too. It doesn't matter one bit if you actually paid for the materials months and months ago.
This one idea gives us two completely different ways of looking at a business. You've got the cash view, which is simple, right? Money in, money out. But like we saw, it can be super misleading. Then you have the accrual view, which is built on that matching principle. It records business activity when it actually happens, not just when cash changes hands. Yeah, it's a little more work, but it gives us the real story of a company's health.
So how do accountants actually put this into practice? Let's open up the toolkit and look at our first time travel tool. This one is for when a company pays for something today that it's actually going to benefit from way down the road. We call these prepayments. You know, we do this in our own lives all the time without even thinking about it. Say you pay for a 2-year magazine subscription all at once. You wouldn't think of that entire payment as just a January expense, would you? Of course not. You'd kind of mentally spread that cost out over the 2 years you're getting the magazines. Well, accountants do the exact same thing, just, a bit more formally.
Here's a perfect business example. A company pays $2,400 for 2 full years of insurance coverage. All that cash is gone from their bank account right now. But using that matching principle, the accountant knows the company has only used 1 month of that coverage so far, so they record just $100 as this month's expense. The rest, that $2,300, it's not a cost yet. It's a future benefit, something valuable the company now owns. In accounting speak, we call that an asset. It's time travel, moving a current cash payment into the future.
Okay, so what about the complete opposite? What happens when a business uses a service right now, but won't actually pay the bill until sometime next month or next year? This is where our accountant has to travel back in time. And the technique they use is called an accrual.
And we all know this one intimately. You use electricity all through December. Did that cost you money? Absolutely. But you're not going to pay for it until that bill shows up in January. So to get a truly accurate picture of December's profit, we have to account for that electricity cost in December when we used it.
So here's how that plays out in a business. Their financial year ends, but the bill for the last 2 months of electricity, it just hasn't arrived yet. Looking at the records, they see they've already paid $6,000 for the first 10 months. So the accountant makes a solid estimate that the missing 2 months will cost about $1,200. Then they time travel that $1,200 expense back into the current year, matching the cost to the period when the electricity was actually used.
So we've traveled to the future with prepayments, and we've traveled to the past with accruals. But there's one more reality check we have to deal with. Sometimes when you sell things on credit, you just don't get paid back.
So imagine a company has made a ton of sales where customers promise to pay later. Their books show that people owe them a grand total of $500,000. In accounting terms, this is an asset called trade receivables. And, on paper, that looks pretty fantastic.
But here's the hard truth. The company knows from experience that some of those customers, for whatever reason, are just never going to pay up. So if they report the full $500,000 as an asset, they aren't really telling the truth about what they expect to collect. They're being too optimistic.
So they do something really clever. They create an allowance for doubtful debts, which is basically a fancy term for a realistic estimate of who's not going to pay. This reduces the value of what they're owed to a much more honest number. In this case, it drops to $437,500. You can think of this as the accountant looking into all the possible futures and choosing the most likely one, making sure the numbers reflect reality, not just wishful thinking.
Okay, so we have our three key tools: prepayments for the future, accruals for the past, and bad debt allowances for a strong dose of reality. Let's pull this all together and see how these adjustments completely transform the financial statements.
Let's just walk through this because it really summarizes everything. Take prepayments. By moving a cost to the future, they actually increase this period's profit, and they create an asset on the books. Accruals do the exact opposite. They pull a future cost into today, which decreases profit and creates a liability. That's a future obligation to pay. And finally, that bad debt allowance also decreases profit because it recognizes a potential loss right now, which gives us a much more realistic value for our assets.
So the bottom line is this. Without these adjustments, financial reports would be, well, basically a work of fiction. These accounting tools, our awesome methods of time travel, are what let us cut through all the noise of cash flow timing and actually see a company's performance and position with real clarity.
So it turns out that cash in the bank isn't profit, not even close. Profit is a much more interesting, more complex story, one that can only be told by these accountant time travelers. They pull costs from the future and push payments from the past, all to give us one single true picture of the present. So now that you know the secret, it makes you think, doesn't it? What story are your own financials really telling?